Hello, I'm going to show you a formula for predicting the price of gold. And this formula is based on harmonic astrology. And specifically what this formula does is predict the price of gold over the coming 3 months. So when you make a prediction, you make it for some time period. And this is specifically over a 3-month period. So if you want to know what gold prices are going to do over the next 3 months, supposedly this formula will tell you. So does the formula really work? Well, I'm going to describe the research results. So there's 2 things I'm going to do in this tutorial video. I'm going to tell you what the formula is. I'll tell you what the formula is for predicting gold prices. And number 2, I'll tell you what the evidence is that the formula works. Very simple. There's a formula and does it work? And in the process of doing that, I will be describing the software that's used to do this analysis, and at the end I'll mention some references for how the formula was discovered, references that tell you how to do the research yourself to get these results. Okay, so number 1, what is this magic formula that will tell me if gold prices are going to go up? Okay, the formula is in the Series 2.0 software. This gold forecast at one time cost $300. It was an option of the older versions of Sirius. In Series 2.0 we just included with the software, and the formula is in the program. And I'll show you how to go into the program to see the formula, and then I will summarize what it is. Okay, so here's the Series 2.0 software. I've got one of these pastel art wheels, which is an option. This particular wheel style is not included as part of the program. But I'm showing these pastel wheels in different videos because people have asked to see them in the optional add-on to Sirius. Anyway, that's not part of our main concern right now. Our main concern is how do we predict gold prices? Okay, you go to forecast icon. And this may not be obvious. It says electional astrology graph. I think I should change that to say electional and mundane astrology graph. Something like that. It's transits. What the transits are in the sky, not transit to natal. So this gold forecast is based on just what the planets are doing in the sky. It's not related to some chart for when gold trading began or something like that. It's based on just where the planets are in the sky. And then we go to financial forecast in the pop-up menu. So there are a lot of choices here. So we select that. That's how we get into the gold forecast. And then you'll see gold forecast 1, lower yield, lower risk, and gold forecast 2, higher yield, higher risk. These are the 2, this one and this one. This is the gold forecast. There are 2 variations of it. One gives you more money, higher yield. Well, why do I want lower yield? Give me the money. I want higher yield. Well, the reason you might want lower yield is because the lower yield has lower risk. And I'll be showing this to you shortly, what the difference is between these and what we really mean by lower risk and lower yield. But anyway, there are 2 formulas. All these other things here are things that I was experimenting with myself as I created different formulas to test different ideas in some of the research which I'll talk about shortly. Okay, so our first thing is, what is the magic formula? Okay, well, I can click on this and then click on the button Customize Highlighted AstroSig. It means customize the astro signature. I'm actually not going to customize it, I just want to see it. So I'll click on this, and then you have all these different methods for forecasting, and we're going to select the transit to transit because, as I said, that's what the forecast is based on. And there is the formula on the left. It may look overwhelming at first, but this is simply a list of everything that makes gold prices go up. That's the magic formula. And I've got a nice, neat little summary of it, so we don't have to, look at all these details. But I just set this formula up in the program, and the research showed that it actually predicted gold prices. Well, rather than go through all this little type here and detail, let me show you the summary in my presentation here. Here's the summary. What makes gold prices go up? Sun and Jupiter in 7th and 14th harmonic. That's the biggest thing that the research showed made gold prices go up. I looked at Sun and Leo and Jupiter and Leo and all these different things. I couldn't make any sense of it. This worked. What a 7th harmonic means? It just means you divide a circle into 7 pieces. So when Sun and Jupiter are 1/7 of a circle apart, or 2/7 or 3/7, and the 14 means 1/14 or 2/14, 3/14 of a circle, that gets 5 points, and the others get 3, 2, or just 1 point, so this gets the most points. So when Sun and Jupiter, as they approach being exactly 1/7 of a circle apart, gold prices go up. Is that amazing or what? Now I can hear the skepticism out there. You know, if you don't believe in astrology, you would obviously think I'm nuts right off the bat. And if you believe in astrology, you may be thinking, what? 7ths of a circle there? That's a minor aspect. That's not important. Okay, the research showed that gold prices go up when Sun and Jupiter are a 7th or a 14th of a circle. And that's what's in this list. Right here it says... I just highlighted it, and on your captured screen it's probably too small to read, and the resolution's low, which makes it even more difficult. But it's very readable in the actual program, and it says Sun, transiting Sun and transiting Jupiter are in harmonic 7 only. That just, if you know about harmonics, you know that 14th harmonic also includes 7, and you have an option not to include that. It's a little bit technical. I want to just give you the basic idea. Well, not that technical, but if you're not familiar with harmonic astrology, there's a lot of information to get all at once, and I have other videos on that. The point is this. This line says 7th harmonic gets a strength 5. Orb is 15 degrees in the harmonic chart, which sounds like a lot, but it's not, because it's an orb in the harmonic chart. And there's the 14 with 5 points, and so on. So they're all listed right there. Okay, so let's go back to our summary. Also, when Sun and Jupiter are in 21st or 35th harmonic, now this may sound really unbelievable, it gets 3 points. And when Sun and Jupiter are in 28th harmonic, it gets 2 points. You may have noticed that 14 equals 7 times 2, 28 equals 7 times 4, 21 equals 7 times 3, 35 equals 7 times 5. These harmonics all are based on 7. They're all interrelated. The bottom line is this. When Sun and Jupiter are 1/7 of a circle, or 2/7 or 3/7 or 1/14 or 3/14 with a certain orb, gold prices go up. And also 1/21st and so on, 1/35th and 2/35ths and so on. Also goes up, but not as much, so it gets 3 points. The more points, the more the price is going up. So that's the main predictors. I put those in bold blue to emphasize that those are the main things. They get more. They're getting 5, 3, and 2 points, more than the 1 point that these other ones get. So these are giving less impact. 5 points has 5 times more. Predicts that the prices will increase 5 times more than if only 1 point is given. So all these harmonics, all between Sun and Jupiter, all based on 7. Also Sun conjunct Jupiter. Jupiter and Neptune in 7th harmonic caused gold prices to go up a little bit. I gave it 1 point. And now, if you think these minor aspects are weird, get ready for this. The other thing that predicts gold prices is a 4-planet relationship. The 4 planets are Sun, Mars, Jupiter, and Uranus, a midpoint to midpoint. So we take the midpoint of Sun and Mars, the midpoint of Jupiter and Uranus, and when those midpoints trine or sextile each other, or are in 9th harmonic, gold prices go up. We gave it only 1 point. All these 3 get just 1 point. It correlated with prices going up. It may sound unbelievable, but look at it this way. If you believe in astrology, but you don't believe in all this harmonics and midpoints and stuff, people think you're crazy for believing in any kind of astrology. So this is just another kind of astrology that is not probably not that popular among most astrologers, but it actually predicted the prices of gold, and I'll show you that evidence, as soon as in a few minutes here. You got the idea? So gold prices go up when Sun and Jupiter are in these fractions of a circle apart from each other. Also when Sun is conjunct Jupiter. Also when Jupiter and Neptune are in sevenths of a circle apart from each other. And also when there are certain midpoint to midpoint relationships that are basically soft aspects, because ninth harmonic, like trines and sextile, is soft. Soft relationships of Sun, Mars, Jupiter, Uranus midpoints, and these particular distances between Sun and Jupiter, and also Jupiter and Neptune. That's the formula. Now, here's a really important thing when you're developing formulas. Question: is the formula simple? This question right here is a huge question. Here's why this question is important. If your formula is complicated and has a lot of seemingly arbitrary things, like, Mars is in Pisces, or Venus is in declination, parallel declination with Neptune, and the ruler of this is somewhere, just a seemingly random number of things, and they all have different orbs, you can always find things that will match your result. If you just by random luck, certain things are going to work. So if your formula is not based on any reasonable theory, and if it's not simple and consistent, it's probably not going to work on new data. So this worked when we tested it on existing data, and we'll see that we also tested it against new data, and it continued to work. So we replicated the study. My point right now is this. You want your formula to be simple and consistent. Is this formula simple? By simple, I don't mean that the theory is unappealing or appealing to you, but is a consistent concept used? Well, to some extent, yes, because we used the same orb, whether it was 1/7 or 2/7 or 3/7, and all of the orbs are based on harmonic theory, and we didn't cherry pick the orbs. The orbs are consistent. It might be that a 2/7 aspect is stronger than a 1/7, or a 3/7 is stronger than 2/7, and I could have made the formula work better by finding out which ones worked better. But you see what the problem is? If you just hunt around for anything that works, you'll always find something that works. You want to base it on a simple theory. Very, very important. So the orbs are simple. All these harmonics are based on 7. That's fairly simple. But it's not completely simple. We threw in Sun conjunct Jupiter. I don't like that Sun conjunct Jupiter. I threw it in there because it worked, but I'm a little skeptical of it because it's not consistent with the rest. Do you see the trade-off? If you're doing astrological research, you have to do a trade-off of something that works with the data you're analyzing. I'm analyzing gold prices. I see what makes gold prices work, but will it generalize to new data? Will it continue to work, or am I just finding things that happen to work? So you pick things that work, but you try to keep it simple. You're guessing. You're playing with things as you develop a theory. So I threw it in there. I kept the Sun conjunct Jupiter because it did correlate with high gold prices. I wasn't crazy about including it because it has nothing, it seems very different from this. So it's a trade-off. Sometimes you include it because it's really working, but then if the formula is complicated, it probably is not going to work when you test it with new data. I hope you follow that idea. It's very, very important. The Jupiter-Neptune is a little inconsistent because I didn't also include 14th like I did for Sun and Jupiter. But when I tested the 14th, it didn't seem to work too well. So I kept it in there. So the formula is fairly simple. fairly consistent, but not completely so. And this is typical. You don't want to avoid an idea just because it doesn't fit. Maybe it works. Maybe that's how life works. But on the other hand, if it looks very arbitrary, it probably isn't going to work. So there's a trade-off there. It's a fairly simple formula, not quite as simple as I would like, but still fairly simple. You follow that? This is the reality of doing research, because it's exploratory research based on certain assumptions of what we think is likely to work, but not being closed-minded to new possibilities. This is how research is really done. Now, the higher yield and higher risk formula is even sloppier, more complex, because I threw in a Venus-Mars in fifth harmonic. I don't have a Mars-Jupiter fifth harmonic. Well, there's some consistency there, but this was all Sun and Jupiter, and now we also have Venus-Mars. There's a Sun trine Saturn thrown in there. So it's a little more complex, but it did give better results. So you can play around with different formulas. And this is the reality of how research is done, is you see what works and you see if it matches theory, and you see if you come up with something nice and simple and elegant, and you try different things. So even though this formula produces better results, I'm going to show you the results in a minute. My first thing is, what is the formula? There are two formulas. I like this one. It doesn't produce as high a correlation as we'll see in a minute. The results are not as spectacular, but it's simpler. I might even want to simplify it more and leave out some of this stuff. So two variations. There's some overlap. They both put a lot of emphasis on Sun and Jupiter in seventh harmonic. That seems to be the thing that really works. Here we give it 7 points. So you can create formulas that are a little different from each other, with a little bit of different trade-offs, and use those for future research. Okay, now I want to point out something here. Some of you may be thinking, if Venus and Mars works in fifth harmonic, and this works, why don't you just make a list of everything that works just to get a hugely high correlation? If you keep adding individual things that predict gold prices, can't you just keep putting them all together? In other words, if I find Sun and Jupiter in seventh works, and Venus and Mars work, why did I leave out 14th harmonic here? Well, here's a strange if you're new to this kind of research. It doesn't work that way. It's not that simple. You can have things that work individually, like Sun and Jupiter in seventh harmonic can predict gold prices. Venus and Mars in fifth harmonic can predict high gold prices. But when you put them together, it may not. That may seem counterintuitive or not logical, but you can have two things that predict a result, but then when you put them together, one of them may no longer work. So what I'm saying is this. It's not that simple. Two variables may be good predictors. These astrological harmonics that we're saying they predict gold prices, even if it's not literally a causal relationship, doesn't matter. We'll just say that they predict the gold prices, but combined together they may not. The bottom line is this. You have to experiment with different combinations to see the results. You could have 5 things that work individually, but when you put them together, some of them may no longer work. This is described, for example, many places, of course, on the internet. Here's one place. Let's see, I've got a browser up here somewhere. Here it is, just an article at uvm.edu by Professor David Howell back in 2001. For one of his classes, probably, he wrote these notes and this section on suppressor variables. If you're curious about how that could happen, or you want to follow what I'm talking about a little bit more, it's related to this issue of, called suppressor variables. And he gives a nice description of it here. Okay, what I'm trying to say here is that doing this kind of research is maybe a little more complicated than you might imagine, because when you combine things together, they can not work the way you thought they would work. Okay, so you try different combinations to see what combinations of things will work well together to give a good result. Okay, that's the formula. Bottom line is this. The bottom line is that Sun and Jupiter in 7th of a circle cause gold prices to go up. And also 14th and 21st and 35th. These are the biggies. And especially Sun and Jupiter in 7th harmonic. Very strong relationship to high gold prices in the data that we analyzed. Okay. Now, let me show you what the results are. First of all, I'm going to tell you how you can replicate the results. What you do is you go into the Sirius software, pick the gold forecast, and run it starting January 1st, 1975, because that's when we have data. Let me show you. I'm in the Sirius software. I'm going to cancel out of this customizing and viewing of the astro signature, and I will make sure I've unchecked other forecasts. I check I'm going to do the low yield, low risk, and if I click on correlation data over here, it shows me that there's data for gold is available from January 2nd, 1975 to January 21st, 2006. I did this research back in 2006, in the summer of 2006, and that was the data that I had when I did the research. So we just, we'll start January 1st, 1975. Is that what I said? Let me click on that correlation data again and look at that. Yeah, January tells me data available from January 2nd, actually, 1975. And then we could run it for the 3 months. So that would January, February, March till April 1st, 1975. And then you just click on Begin Analysis. And it takes quite a while to run. You see the number going up, 16, 17, 18, 19, 20. It doesn't just zip through it in a few seconds and say, here's the result. It takes a while to run. And we will get a graph of the actual prices, because we have them, as we saw, we have gold prices starting in January 1st, 1975, and the predicted prices. Excuse me, and here it is. The light green, which is this, is the actual price, and the dark green is the forecasted price, and then up here it also tells me that we have a correlation of 7%. Now, to do the full research, what you do is you select 3 months here, select January 1st, 1975, and you click on Auto. You click on this Auto button, and you tell it to do, in this case we have 126 3-month periods, because we have data from 1975 to 2006. If you calculate it out, it comes out to 126 3-month periods. And then you just click on OK, and then Sirius will save the results for all 126 3-month periods and put it in a file. So we'll do the entire analysis in one click. You just click on OK, and it will do it. It may take about an hour to run it, and it will do the 3-month correlations throughout the entire time period. Okay, so when you do that, after it's done, you get these results. Here are the results. The results are that on the left I have the high yield, high risk results, and on the right I have the low yield, low risk results, we find that the correlation is 0.08. I put it out to 3 decimal points. Usually it's just given to 2. 0.08 is the high yield, and the low yield is 0.06. It's not a very high correlation. It's only, that's 8%. It's a very low correlation, but because we're analyzing it over a large period of time, it's statistically significant at the 0.001 level. So it is statistically significant, meaning that it's extremely unlikely to happen by chance. And I read this data the data that was saved in Sirius. You can read it into a spreadsheet. It saves it in what we call common delimited format. You can read it in, and in the spreadsheet I told it to total the values and show me how many have certain kinds of correlation values. A correlation of 1.0 is perfect. A correlation of 0 means there's no relationship. And so what this is telling me is that the high risk, high yield correlation is mostly because some high correlations were found for certain 3-month periods. The low risk, low yield doesn't have these extreme cases. In other words, the low risk, low yield had almost no correlations above 0.4. There's only one greater than 0.4, only one less than minus 0.4. So what this means is it consistently picked correlations with what we call less variability. Between 0.2 and 0.3, the low risk, low yield had 20 positive correlations and no negative correlations. So it's less variability. So this may be a little bit technical, but this low risk, low yield formula works more consistently. It gives low positive correlations more consistently, whereas the high risk has a smaller number of extreme correlations that work. So this is more trustworthy, more consistent, and the formula is simpler. Inclines me to suspect that the lower yield, lower risk formula, even though the correlation is only 0.06, may actually be a better formula. So if you're doing this kind of research, there are things to think about. It's not just simply what gives a high correlation. You have to think about it intuitively, not just number-wise. Intuitively, what feels better, what is a simpler formula, and also which one has lower variability and more consistent results. So, and this one does, which also raises the p-value, the probability. So this comes out with 0.01, almost as good correlation as the high yield, even though the almost as high probability, almost as good a probability as the high yield formula, even though the correlation is much lower. So that may be getting a little bit technical, but the bottom line is this. We have a formula to predict when gold prices go high. And we have two formulas. One that has a lower correlation, but is a simpler formula, and a more consistent formula. Okay, now here's where the excitement really starts, is we replicated the study. Because I finished the study in 2006, in, I think it was 2013, last year, after about 7 years, we had 7 years more data that I never analyzed. And a colleague, fellow astrologer, Linda Berry, downloaded the latest gold prices, the gold price data from 2006 to 2013. We downloaded it, we imported it into Sirius, and we analyzed it. So this was exciting. We had it's been 7 years since I did the original study. We had 7 years of new data. Would the new data confirm our findings? Very exciting. I had no idea. And here's what we found out. That the high yield formula did not work very well. The correlation, the average correlation over those 7 years was only 0.02. It dropped from 0.08 to 0.02, and the p-value is 0.38. We want the p-value to be low, the probability to be below 0.05. This is bad. This is bad for us. It shows that the high yield formula doesn't work. It did not work on the new data. What about the low yield formula, which personally I was more optimistic about? It did better, 0.04. In fact, it did almost as good as the original data. So the high yield did poorly on new data. The low yield formula did almost as well on the new data as the original data. The correlation went down from 0.05 to 0.04. So the original study correlation was 0.05. Right? If you go back to our table, there's our original correlation. Well, it was actually 0.06. 0.057 rounds off to 0.06. So it went down, but not that dramatically. And the p-value is better than the high yield. So even though the high yield did better on our exploratory research, in our replication of the study, this is a hypothesis test to determine if the formula really works, the low yield did much better. And this is very interesting, is that one thing I didn't like about the low yield formula. We go back to the low yield formula. I didn't like that we had Jupiter and Neptune thrown in here. I also didn't like that we had Sun conjunct Jupiter thrown in here. When we added Jupiter and Neptune in 14th harmonic, the results were better. So it was more consistent. We used 7 and 14 with Sun and Jupiter. A simple formula would say we should use the same harmonics with Jupiter and Neptune. The simpler, the more likely you found something. The more complicated, the less likely. Sometimes the reality is complicated. This is only a guideline. But by simplifying the formula, by making the Jupiter-Neptune more consistent with Sun-Jupiter, the results improved. And interestingly, in the high-risk formula, I used Jupiter and Neptune in 7 and 14. So the bottom line is this. The simple formula, the simpler formula, which is the low-yield formula, where am I here? I'm up to here. The low-yield formula, which is simpler, if we add the Jupiter-Neptune 14th, which makes it even simpler, more consistent. We use 7 and 14 for both pairs of planets. The correlation got even a little bit better, 0.05. Our probability went all the way down to 0.09, getting very close to this cutoff point, often used of 0.05. Now, in this replication study, we have only 26 sets of data, only 26 3-month periods. The original study had 126. What does that do to our likelihood of getting statistical significance? Do any of you know any statistics concepts, research concepts? If I'm doing a much smaller study, because I have only 7 years of data, I have only 26 3-month periods, whereas the original had 126, well, I'm much, much less likely to get statistical significance. The more data you have, the greater the power of your analysis. That's a technical term. The power of your statistical test goes up when you have more data. So I'm not expecting to get statistical significance, but I'm hoping to get a correlation value that does not become much worse, because a correlation value is called an effect size. It's not affected by the amount of data you're analyzing as much, whereas the p-value is. So we have a p-value almost as good as the original study with the low risk and low yield formula. The bottom line is this. Our replication of the results, our hypothesis test, suggests that the low yield, low risk formula actually works. Very strong suggestion. Is it a proof? Have we proven astrology? No, because we need to do more and more studies. The way this research is actually done is by gradually exploring, refining, and then eventually you get to more and more solid, more solid studies and more rigorous and clear hypothesis tests. So the research is progressing very, very nicely. If you just jump in with a lot of a priori assumptions and do a hypothesis test, you almost never get statistical significance. It's better to do exploratory research based around certain expectations of what you want, keeping your formula simple and gradually refining it. So this research is very exciting. This is realistically how research is done. We're gradually and slowly closing in on finding formulas that actually work. That's what appears to be going on. We need to keep doing the research and see where it leads us. So, the emphasis is on Sun and Jupiter and Neptune, especially Sun and Jupiter in Harmonic 7 and 14. And here's the point I just made. We are gradually developing astrosignatures that may evolve into a science of astrology. And we are gradually moving towards being able to do hypothesis tests which can produce the strongest validation of a theory. This is a realistic way, an intelligent and sophisticated way to do research in astrology by exploring, refining, and improving your formula and learning what works and what doesn't work. And amazingly, I find over and over again that the recommendations that I get from people in data mining that your simpler, more consistent formula is likely to get validated better than your formula, which is a little riskier, even though it gives better results. Over and over again, I find that that's true. So again, our simpler formula is working better. The low-yield, low-risk formula appears to actually work. We're getting more and more evidence that it works. This is what I said about effect sizes. The effect size that we have here is that when we have 100 to 200 data to compare, we had 126, I think it was, data in the original study, only 26 sets of correlations in the replication study. We're getting results that are interesting. So with around 100 to 200 sets of correlation values is enough. This compares very favorably with the Glaucon research, which also had very small effect sizes. So there's something in research called an effect size, and the smaller the effect size, the more data you need. So these effect sizes are small, but they're not ridiculously small. And they will be improved as we figure out how the formula works, if we're really on to something. Okay, so those were my main 2 points. I told you what the formula is to predict gold. I went over some of the evidence for it. I think in these previous slides I may have skipped over the references. Yeah, here's some of the references. I have articles. Article number 42, for example, on this website page. Let me show you. On this website page, astrosoftware.com/astrologyarticle.htm. Article number 42 is the replication study that Linda Berry conducted and I assisted her with, and the earlier study, number 29. So you can read those studies if you want to go into all the details of the research if you're an intense researcher. But if you're an astrologer and you just want to know what ideas work, you don't need to go through all those technicalities of research. That's what researchers like myself and others do. We're finding formulas that look like they work. And the bottom line is this: Sun and Jupiter in 7th harmonic appears to correlate with gold prices going up, and also some other things, Jupiter, Neptune, some 4-planet patterns, etc. Which I showed you the formula earlier in this video. And if you have the Series 2.0 software, you can look at it in the software. So I put here exclamation points. This is impressive. The lower yield, lower risk results with replication study, very, very impressive. So I talked about the effect sizes, and this is where I was. In going over this, I've shown you how the software works. There are two other videos, one called Financial Astrology, How to Forecast Stock and Commodity Prices using Kepler and Sirius, another one, How to Import Data and Select Peak Dates in Kepler and Sirius software. These two videos will show you how I find the formula. So that I'm not going to go over that again here because it's in these other two videos. And other than to mention that one technique is to use a feature in Sirius to extract dates when prices reach a high. So there's a feature in Sirius that you can scan through all the price data. It will pick out the dates on which the prices are high, and then you analyze those with the exploratory research methods. That's the basic thing that I did. It's explained in these other videos. That's how I discovered the formula. And also there are many other tutorial videos on using other features of Kepler and Sirius. So that's it. I've told you what the formula is to predict gold prices, given you some idea of what the evidence is, and there are complete papers that you can read. I showed you the links to those if you want to follow this in more detail. Giving you an idea of how the software is used to give you all this information, and the other two videos show you how the formula was discovered. The bottom line is that we are in a new world of information where people who have the technical orientation can work through this stuff, find things that work, and the practicing astrologers don't have to get so involved in all these technical details of the research, but it's nice to have an idea of how it's done, how it works, and what the results are. So very mind-boggling information that it appears we really are headed into a whole new world that opens up through the information age, to develop a kind of astrology that I think even most astrologers, would have trouble imagining is possible. So just like the 20th century created revolutions in technology, to now we have airplanes and rockets and internet and computers, astrology could evolve, and looks like it is evolving, to be a serious discipline, using these tools, and to deliver some concepts and final results that practitioners can use. So that's it, my friends. The gold forecast. Thank you very much for listening. God bless. Namaste.